The Bitcoin price out to a new high. It did touch intraday on a couple of days that 70,000. And, you know, we wonder how.
Hi everyone, welcome back to Finance Wolf. In this video, Michael Saylor talks about cryptocurrencies, including Bitcoin. MicroApproach views Bitcoin as the most valuable investment asset. The ultimate goal is to accumulate more. Michael Saylor claims that Bitcoin is regarded as a valuable asset in the financial world. This property is genuinely special and unique in the globe. Investing in Bitcoin and hanging onto it can be a prudent financial move. The micro-strategy behind Bitcoin is that the people with the greatest quantity will win. It doesn't make sense to sell the winners and acquire the losers when it comes to Bitcoin. It is anticipated to grow in value over time more quickly than the S&P index and commercial real estate. Since Bitcoin is the clear winner, we will continue to hold on to it and explore other avenues for acquisition. For example, we may use cash flows to pursue equity or capital raises, or we may think of other creative ways to acquire Bitcoin. Currently, institutional investors who want to buy Bitcoin can invest in well-known ETFs like Fidelity and BlackRock. AFIFs are another business that comes to mind with a Bitcoin strategy akin to MicroStrategy. These ocean-going container ships are capable of carrying enormous volumes of capital. Billions of dollars can be invested in them every day. BlackRock ETFs may have a premium, but they lack good performance and leverage. However, they can manage enormous quantities of cash without engaging in excessive trading. Remember that MicroStrategy is unique because of its strong capital position. Shares are not redeemable, potentially leading to a premium in their trading price. It's important to remember that MicroStrategy is an operating company. When their shares trading at a premium, they have the option to raise capital through convertible debt or other means. When they engage in such actions, they are doing so at a higher value than the underlying assets, calculates an increase in value for their underlying shareholders after a debt deal where they exchange the debt for their common stock. Shareholders now have a higher amount of Bitcoin per share compared to before the deal. This presents another perspective to consider if you're looking to pay 25 base points and have a leverage ratio of 1-to-1. Purchasing the ETF would be the way to go if you're looking to generate a return and avoid fees while taking advantage of leverage. Consider investing in a stocks such as MicroStrategy. You could consider us similar to a financial analyst. The strategy is air freight. They are Federal Express, and they can transport you at a faster pace. However, it's important to note that their payload capacity will always be significantly lower compared to that of a supertanker or a container ship. There is room for both of those strategies, and in fact, they complement each other quite well. Michael Saylor thinks that firms like MicroStrategy are responsible for the success of ETFs, whereas MicroStrategy benefits from the existence of the ETF, among other things. Michael Saylor talked about, so please watch the entire video and feel free to share it. And please subscribe to our channel, Finance Wolf.
Much of this is because of the ETF launches and all of the publicity and the competition among the 11 ETF issuers, and how much of this is flight to safety. After all, we heard New York Community Bank, under duress, has now been taken over, and there's another bank in Philadelphia. So there's no counterparty risk when it comes to Bitcoin. And so maybe that's part of why Bitcoin has shot up here. And as you know from our research, we think this journey has miles to go. And this is the true puzzler for us. So these are credit default swaps, and they have been coming down. And they came down especially after the Fed put in place that long-term, the funding mechanism in response to the regional bank crisis. Now that's going away on March 11th. Let's see what happens. Could be fireworks. I don't know. But there's another thing that could be going on. And it's back to all of the money, the capital flowing into private equity, private credit funds that don't have to mark to market like we do every day. And to many people, that's a lot more comforting than watching the volatility in the public markets. Well, mark my words, if we're right on multifamily, there are going to be some dramatic mark to market moments in those worlds. But we've seen capital stretching for yield in apartment buildings, at one time office buildings, in warehouses, and so forth. And maybe we're going to see the other side of that after this long-term funding facility ends next week. So, and then another way, and I showed you this last time as well, metals to gold. So this is gives us a sense of gold's purchasing power. When the periwinkle line is moving down, gold's purchasing power in terms of metals is increasing. And you can see how tightly correlated this ratio has been with long-term interest rates, certainly since 0809, but even there was a correlation before 0809 directionally, until the Fed started tightening. And I think what this is telling us is gold's purchasing power going up in terms of metals is telling us we're in a bit of a deflationary period. And there's been a little bit of a flight to risk-off assets. But you'd never know it from the Treasury yield because the Fed has been so tight. The only way we see the Treasuries expressing concern is through that inverted yield curve. Now I'm going to show you a couple of charts that are puzzling, somewhat puzzling. You can see that gold is breaking out here. Is this a flight to safety? Are there things going on out there, whether it's commercial real estate in the US or recessions around the world, or crackdowns in China and Russia and elsewhere? Is there a flight to safety? We don't know why the gold price is going up like this, but it is interesting to note that the metals to gold price is still near a very low level, near recessionary levels. So that's kind of interesting. Now let's take a tour through some market indicators. The dollar is, again, in perspective, the dollar has been moving up for nearly 10 years on balance. While many people focus on, the last year or something and say, oh, the dollar's weak. The dollar is in an uptrend. And that is a very deflationary phenomenon. Most commodities are priced in dollars. And so here you can see the Bloomberg Commodity Index, and it has been in a downtrend since '08. And here I like to explain what caused that spike in '08. It actually started in the late 90s. When we had a number of reasons for the Fed to stimulate. Russia defaulted, causing uncertainty, but it wasn't until long-term capital went under and threatened the financial system that the Fed really started easing. That was in '98, and then in 1999 they eased even more out of fear that Y2K, the turn of the century, would knock all the computers in the world out and the economy would shut down. And then during the tech and telecom bust, after the economy did not shut down, but tech and telecom did go bust, the Fed stimulated again. And you can see what happened. It caused that price spike. I want you to remember back to the yield curve, that underlying deflationary undercurrent. This is what I mean. This is a downward trend in commodity prices that started in '08. And it's resuming its downtrend. And strikingly, commodity prices today are where they were in the early '80s. I think many people are surprised to hear that. Of course, technology is a reason. It's easier to get commodities out of mines and so forth. So that's an explanation. But this suggests that it's not inflationary, that we're not living in an inflationary period today. and that the reason we did have that inflation spurt was a massive supply shock around COVID.